So what is going on with gold prices? Oh, really? What's going on? I can point out the moving parts, but you can't blame me if it doesn't make sense. If you've been paying attention to the news, Fitch Ratings downgraded the United States long-term credit rating from a AAA to AA+. I basically said, everyone's tired of you, man. They don't like your debt ceiling standoffs, and maybe you guys weren't so hot to begin with. Now that, of course, sent the US dollar into the ground and gold to the moon. Actually, hold up. Let me check my notes here. Actually, it looks like that's not true. What really happened is the dollar pumped the same day the news hit, hitting a 3-week high. Gold and the stock market, they took the hit. Now, the reason for the stock market fall, it's pretty straightforward, and some of the drop in gold prices too, but there has to be more to it, right? It turns out there is. Before we get back to it, if you're looking for precious metals, hit up SD Bullion. New customers even get gold and silver for spot. It's sdbullion.com/new. Let's look at the obvious stuff first. A stronger dollar is going to mean weaker gold. That's a big oversimplification, but it has been true lately. The way that it plays out is that when strong economic data comes in, the market thinks that the Fed is going to continue to raise rates. Those rates fuel treasury yields, making them more attractive than something like gold. Maybe not more attractive to you or me, but we're outnumbered. But what about that credit rating downgrade? That's a big deal, right? Well, mostly that was ignored, at least outside the market. And responses from the White House, Goldman Sachs, maybe you saw them, it almost seemed like they were just irritated. The debt crisis, it's been over for months. Next 3 years, they're going to be fine. Who's Fitch anyway? Moody's still thinks the U.S. is tip-top, and S&P, well, I guess they've been onto it for years because they switched the credit rating back in 2011. So what's up with Fitch? Well, some new data got dropped on top of them, and somehow that puts the curtain on most of what they said. They kind of got looked off. ADP coincidentally dropped data showing a rise in private payroll by 324,000 jobs. Now, what does that even mean? It's just a number, really. The expectation, though, was 189,000, so that was a convenient enough counter-argument to Fitch's downgrade that I guess everybody just kind of shrugs it off. That'd be a good movie title, by the way. The Big Shrug. So that's the U.S. economic side. We have data being used to form different opinions. Put all that into bucket A. The takeaway there is that the U.S. dollar is still running hot for whatever reason. This is one of those times, though, where there's actual information affecting gold price directly as well, and that's global demand. It went down in the second quarter of 2023. Well, actually, we need to look closer there, too. We need to look at sharp net outflows from June. Why so specific? Well, we keep hearing about record gold buying from central banks, and that has continued into 2023. Now, the second quarter slowed down 35% as the Turkish central bank sold a bunch of gold. But even that's only part of this story because Turkish millionaires, individuals, and companies were buying a huge amount in the OTC market. That's due to the country's currency crisis that they've been having since the election. More than a third of the 355 tons of OTC demand came from Turkey in June. At least that's how it looks. So what else? Well, China and India are continuing to stock up, but like everything, there's more to it there. Gold price in rupees is very expensive, and China's economy just isn't doing really well. So that would have put a damper on it. But don't let that fool you. The People's Bank of China was still the largest buyer in the first half of the year. Singapore and Poland, they're buying heavy too. Now, flip that. Germany, Kazakhstan, Uzbekistan, they sold 25 tons in the second quarter. And we are just looking at central banks here right now. If we were to look at that net outflow, we're talking about ETF buying. That's what signaled the overall demand shortfall. So if you put all of that together, it was a soft June. But 2023 in total has been another big year for gold demand, and that's the trend. Now, what's strange about all this is that the big mover lately, what's typically moving gold, the US dollar, just took a punch on the chin and nothing happened. A credit downgrade really should result in a hit to its strengths. It'd be reasonable to think that investors would second guess those dollar investments, maybe look to other safe havens like gold. But that's not the case. I mentioned earlier that the dollar rose to its highest level in 3 weeks, the same day as that news. And then gold dropped, 0.5%? Makes perfect sense. Or not. On the demand front, gold would have been down 2%, but all the OTC buying, particularly from those Turkish buyers, put gold up 7% year over year. And last year was the highest gold buying for central banks since 1950. It's kind of a thing right now. They bought $70 billion worth of gold last year alone, but those ETF outflows from June, well, they kicked off 1 month of net outflows. That triggered a sell-off, and here we are. So if you're trying to nail down your gold buying based on where you think that the price is going to be down to the single-digit percentage points, it's going to be difficult. I'm no analyst myself, but I do watch prices pretty closely. I watch the things that affect price, and this week's moves, they made no real sense to me. Now, not in the sense that I'm completely thrown, don't know what to do, just a simple case of thinking the momentum was going one way, maybe leaning into that slightly, and then the carnival ride just goes the other way, kind of a lurch. But we're talking about 1% swings. And like I said, if you're trying to predict down to the percentage point or even down to a few percentage points, you're probably losing time better spent elsewhere. I'm probably losing time better spent elsewhere, but I guess I'm committed. Now, $20 on a $2,000 purchase just doesn't matter to me, though, in the grand scheme of things. What does matter to me is the trend for price. That's what I'm trying to follow. And really, that's the only reason that I cover these smaller price movements on the channel to begin with. Any move under 1% and maybe even 2% really shouldn't even be mentioned. We can't predict to that level of accuracy. So to a certain extent, it's probably just best to buy on noticeable dips and then carve out points where you're either going to hold off or you're going to buy more. That's typically what I do. As for the trend going forward, well, gold demand is still trending higher, even with June's performance. We're looking at 1 month of net outflows on top of a big multi-year run for global demand. So I guess the way I see it is we all get a $20 discount for buying right now. Okay, so let's call it good there. Let us know if you're buying, if you're assuming this is a dip, or if you think more is coming. Now, none of us really know, of course, but consensus building is fun. So let us know. And then while you're in the comments, be sure to hit the like button if you found any of this interesting. Be sure you're subscribed with notifications turned on if you'd like to see more on the topic. And if you're still here, thanks again for watching. I always appreciate your time. Take care.